Good evening, everyone, and welcome to the today's session of Saturday Talk. We are once again privileged to have Satish Betadpur ji with us. Satish ji is currently serving as the MD, Head of Investments in India for State Street Global Advisors. By qualification profession is a CFA. And apart from that, he's been associated with JanyuTechnologies since the inception of JanyuTechnologies. He's been advising us, mentoring us throughout our journey. And today's topic for us is the dollar strength, that's impact on the Indian economy. As we see that rupee is devaluating every day, reaching new lows as compared to dollar. So we get a lot of messages, a lot of information on WhatsApp, which may not be that authentic. So we thought of requesting Satish ji, who is the master of the subject, to enlighten us on this subject. Sir, over to you. Thank you.
So let's first and foremost, I think let's just have a little bit of short-term history why we are here. Okay. So COVID happened couple of years ago, and economies kind of shut down. US economy and the world economy in general shut down. And the response from the US when the COVID shutdown happened and the economy went into a tailspin was very generous, in the sense they cut interest rates to almost zero, short-term interest rates. That's the only interest rate you can control, is the short-term interest rates. So they cut that to zero. And then also that's monetary policy, and also fiscal policy, which is what governments can do. We're also very generous, where all people, not just families, individuals and families started getting cash payments directly to their accounts. So not only was the interest rate cut, there was cash payments. There was moratorium on payments of debt. So there was a lot of support given to families and businesses during COVID, during the peak of COVID, and even subsequently as COVID started slowing down, because they wanted to protect their economy. Now, I'll tell you why that is important for the rest of the world. US currency, the dollar, is the reserve currency of the world. It's not that somebody made it the reserve currency by diktat. It happens because that's the currency the world trusts in. That's the currency people believe will hold value and will not depreciate. The other choices people had as reserve currencies were euro or Japanese yen, which is occasionally used by people as currencies, but dollar is the dominant currency. Now, so anyway, coming back to COVID, so the response by the US monetary fiscal policy stabilized the economy to a great degree. And so they came out of COVID quite well off. In fact, people of the country, US, their savings rate went up as COVID was winding down. Overall savings rate went up. You would think that would be the other way around, because COVID, job losses, etc., etc. In aggregate, savings went up. So people started actually feeling quite wealthy, because one amount of government gave money to people, their savings rate went up. So once COVID kind of ebbed, meaning came down, people started spending a lot of money. Now, there was a lot of spending in the US, to the extent that you had, when the economy opened, the spending started, rentals went up tremendously. Rental for housing went up. It got to a point where cars were not being made fast enough. So the prices of used car at some points were higher than the new cars that were coming out, because people wanted cars and they weren't enough. So they were even willing to pay high prices for used car, which is very unusual, right? So prices of used cars went up, restaurants spending went up, travel where available, where they could, all of that went up. So people had excess savings, which they started spending. Now, one of the problems were that people didn't want to come back to work. So the labor force participation also declined at the same time. So we had people wanting to spend money, but there were not enough workers, say in restaurants to cook, hotels to take care of people, mechanics to fix cars. All of that was happening while people were willing to spend money. So basically the supply of cash was there, the demand was also there, but there were not enough people to kind of not enough people to take care of all of this. So it basically added to the overall cost pressures within the economy. So that drove inflation up in the US. Now, anecdotally, if you talk to people in the US, they will say that in a restaurant, what used to cost you, let's say $20 for a main course is now costing anywhere between $40 to $50. So that's price of a main course in a restaurant has doubled. I mean, that's a significant thing to happen in the world's most developed, stable economy. It can happen in India. I mean, you could, in a few years, your main course, which could be today in a reasonable restaurant, maybe, I don't know, 200 rupees or 400, it could be 800 rupees in 5 years. But that's emerging economies where prices go up. Not in developed economies like US, you don't see prices go up. Like, let's give an example of salaries of people. Salaries of people, every yearly hikes are if you don't have a promotion, it can be as low as 1 or 2%. Your savings rate was less than 1%. That's the level of the economy. And now all of a sudden inflation kicks in. Your prices have all gone up. Food prices in grocery places where you would pay, say, $50 for a basket of goods is now $70, $80. So therefore, people are expecting salary hikes also. So the expectation is building up that I can't live with 1% salary hike every year. I need to get, substantial salary hike. And this is kind of unheard of in the US. I mean, you get a salary hike if you get a promotion or you change jobs. I mean, same job, you don't generally get salary hikes or substantial salary hikes. So what that again adds to inflation. And not only does it add to inflation, it adds to inflation expectations. So people are expecting that my salary is not only, should be going up. They're expecting their salaries to go up because they expect prices to go up next year. Now, that is a dangerous situation for an advanced economy to be in, because if your expectations are high, that means it will eventually happen. So if I'm expecting car prices to go up next year, I'd rather buy the car today, right? A few years ago in Japan, the expectations were negative. They always thought the price tomorrow will be lower than today. So the economy went into a tailspin there because nobody was buying anything because they thought tomorrow the price will be lower than today. Now that is also very bad. So you have to have a balance where there is a reasonable expectation that prices will be stable, maybe little upward, but not by a wide margin, that you're making a decision based on that. So my buying a car in the US shouldn't be based on the fact that the prices will be higher tomorrow and therefore I buy today. My decision to buy the car will be, okay, I'm getting better features tomorrow, for which I may pay a little extra, but that's okay. But overall, the same car or it shouldn't be like 10% higher tomorrow and therefore I am buying today. That expectation was not there in the US. For the last 40 years, US has had a very stable inflation scenario, and there was no inflation expectations over and above what they call a baseline, which is like sub 2%. So the entire Federal Reserve has had a 2% target for inflation. So Fed in the US has a 2% inflation target and full employment as their two main targets which they manage their economy from. That's the Fed's target. So the 2% inflation has now shot up to 8% in the US. So the inflation is running as high as any emerging markets such as India and stuff. Inflation is running at 8%, unheard of in the US. Full employment, because a lot of people don't want to work, so they've gone out of the labor force because they feel that they have enough savings. Maybe that's temporary, but anyway, right now there's a labor shortage, but inflation is running at very high levels. So the Fed has to do something. They are given a task by their government, by the Congress and the Senate, to maintain price stability, which means 2% inflation per year. Now, if you're running at 8, what do they have to do? They have to cool the economy down. And to cool the economy down, they have raised rates, short-term interest rates, which is the only policy, one of the policy arms that they have. They've raised rates from 0 to now almost 4%. So the rates have gone up in the US. Now, when the rates go up in the US, now bond investors will go back to buying US bonds because that's now more attractive. They're getting a 4% interest rate where they were getting zero. And also it's a risk-free asset compared to, for example, let's say India. India is rated at the lowest investment grade, which is a BAA rating. I think that's where India is rated, lowest investment grade, whereas US, for example, is rated as AAA. So there's a big gap between, when various countries are on this scale, right? So UK maybe somewhere, little below US, and Italy somewhere there below, etc. And there are a lot of countries below India. They're not in investment grade at all. So the India is an investment grade, and that's important because bond investors prefer to invest in investment grade bonds, sovereign bond investors. So what has happened is people who would have invested in countries like India or other countries now are preferring to invest in the US because you are at a risk-free rate, you are getting a 4% yield. Whereas with risk, agreed, Indian rates also gone up a little bit, but it's relative. So there is a flow of funds going from other countries back to the US, which means that the dollar, continues to rise. Now, so that giving you a little bit of a macro picture of what happened in the US. Now, let's look at what happens, why rates move up and down. Rates move up and down. One is because of differentials in interest rates, right? So I gave you an example. Now, interest rates have gone up in the US from where it was to now where it is. So as other countries, but in absolute terms, US has gone up more, or in percentage terms, US has gone up a lot more than other countries. So they've been very aggressive in raising rates because they want to fight this inflation. So interest rates differentials have widened to benefit the US. So there's a flow of funds going back to the US. So that is one of the reasons why you have a strong US dollar. Other thing that happens in what happens in currency is inflation. Generally, countries with high inflations have a depreciating currency, but US has high inflation, but other countries also have high inflation. So that argument about high inflation, therefore currency being weak, is kind of getting washed out a little bit now, because all countries have high inflation, and therefore relatively, and currency is all relative, right? There's no absolute. A currency is always between one currency and versus another currency. So because relatively speaking, inflation everywhere is about the same, that's not making much of an effect in today's currency interest rate scenario. So otherwise, if India was running at very high inflation and US was not running at any inflation, Indian currency would have gotten very weak. This happened just before around 2012-13. Indian inflation was peaking, US was at low, and our currency went from like 50 to 60, 65 in a matter of months. I don't know if you guys remember that. So that was a different scenario why currency weakened in India, right? There are different scenarios. There's no one reason why any currency weakens. So that was then. So we had one episode where our inflation had picked up and the US inflation was stable, our currency weak. Now, US interest rates are going up. Our interest rates are also going up, but not by the same magnitude as the US interest rates. Therefore, most of the money is kind of going back towards the US. That's flows of funds are going back towards the US, which is causing US dollar to strengthen. And if you look at the chart, the line near the top, the 100 is like the base for, let's say, the base for the US. Rest of the currencies are all, how they are depreciating from January 1st of this year. So it's going down. And let's, look at Japan, which is like absolutely at the bottom. How much has it's depreciated almost 40%, This is a major economy which is facing a depreciation of 40%, whereas India, which is really still at the top, which I think the second among the G20, is the second weakest second strongest currency actually, in relative terms versus the dollar. So yeah, we are all panicking saying, oh, it's gone to 82, blah, blah, blah. All of that is all going on. But if you just look at Japan, it was about 100, ish to a dollar. Now it's 140. And in India, like, okay, 70, whatever, 75, 76, it's now 82. So 10%, let's say. So in magnitude terms, we are nowhere near the top, we are like the best two in the world. Now, that has a huge problem for us. I mean, it's got positives and negatives, but that's where we are. So we shouldn't be sitting there and panicking saying, oh, rupee is at 82 or whatever. In fact, we should be panicking and saying why rupee is not at 100. The reason is, that if we keep the rupee very strong, our exports will be completely you can't export, right? It's not competitive. So we need to have, one is to make the exports competitive, you have to have a weaker currency. The other problem is if you make it too weak, our imports get very expensive. So again, it's a balancing act. When currencies depreciate or appreciate, it's always a balancing act. It has to be in relative terms to the rest of the world and what's happening around the world. Now, it's never, in this, that's why I put G20 there. Look at China, it's kind of in the bottom. So when you depreciate a lot, your currency, let's say India was at 100, whatever goods I'm exporting, I can export more, it'll be cheaper in overseas markets. Now, it'll be cheaper to send some things from Japan or China or Vietnam or some other country, right? But at the same time, why does RBI intervene every so often and make you hear about it, right? RBI intervenes to keep the rupee strong. They intervene because one, they don't want a free fall. I mean, because if suddenly one day it goes from 70 to 90, exporters and importers don't know how to price their goods. It becomes very difficult. Whereas if it's a slow upward trend or downward trend, you can at least have some mechanism to price your goods and services with the importing or exporting. So they like a stable decline or a stable increase. In most cases for us is a decline, but that's what is required. That's why RBI intervenes in it. It's not, we will not be able to export anything. We are already, if you look at our trade numbers, we have a trade deficit. That means we are importing more and exporting less. This is all trade happens in dollars. So therefore, this currency effects has affected our trade. There's a trade imbalance. So that's another problem that we have, because we import a lot of oil, and while oil prices may have gone down, the cost of importing oil in rupee terms has gone up. So that's why you don't see petrol prices coming down. You'll hear that oil was at 130, now it's at 80. Why is the petrol? Why are we paying the same amount at the petrol bunk? Why? Because currency has weakened, right? It's not weakened a lot. If it weakened a lot, you'd be paying even more at the gas pump. But the government has intervened and made it relatively stable so that, that the price at the pump is still not a big enough jump that will cause a problem. People only talk about, prices are going up without understanding the full reason why it is. Of course, not everybody needs to understand it, but it's something that we have to manage. Sometimes it's not manageable, right? Like there's so many things, other things also happening. Why it's not manageable, like oil prices today should be coming down, because the world is kind of going into a recession, because as you raise rates world over, usually that's to cool the economy so that you bring down inflation. And so when the rates are going up, economies have to cool down, and as one of the effects of it will be that demand for oil will come down, and it has. But OPEC is keeping the oil at a particular price level. There's war going on in China, which means that they can't export as much as they want to, and there's demand for oil only from certain regions, which is keeping overall oil prices higher. On top of all of that, there is this whole, cooling down of inflation that the US is involved in, and so is Britain, right? Now, what happened in Britain is a classic example where this complete policy battle going on there, or nobody knows what's the right way of doing it. One side, you want to bring inflation down, so you're rising rates. Other side, you're giving money to the people so that they can afford to buy heating oil and gas for their winters. But that is working against rising rate, because that adds to inflation. When you give free money to people, it adds to inflation. Now, so there's cross purpose going on in large economy like Britain. So people are like, very confused there. And if you've been reading about Britain, the pound and the dollar almost came to parity. The pound always was at $1.30 was equivalent to £1. Now it's gone back to $1.10 now, but it was coming closer to parity, meaning $1 equal to £1, which has not happened in many decades. So and also interest rates in UK, which was again very close to zero, have shot up to like 4%. So that these are things that are happening globally. And we are kind of caught up in that storm because we trade with various countries and we are a big importer of oil. Now, if we were not importing oil, and which is one of our biggest imports, we wouldn't be that worried. Our currency wouldn't be that impacted. But we do. And that's all everything is priced in dollars. And so our imports are going up. Our exports are not as competitive as it was a few months ago, so that also is going to make a difference to our economy. But that's the balancing act that we are kind of grappling with. And so anyway, so what's that mean for implications to India and Indian economy? Imports and exports, as I've told you a lot. The other thing that will help is the NRI money, which is a big part of our basket of funds that will come in more, because a dollar is buying you 82. Hopefully they invest in India. NRIs, a lot of NRIs invest in India. So it's a better time for them to invest in India, right? And maybe fixed asset investment like houses or whatever they invest in, or other things. It's good time for them. So that will help bringing in dollars, which will help stabilize the rupee versus the dollar. Again, it's a positive fund flow. Negative fund flow is when we have to pay for all our oil imports or other imports, and money coming in is equivalent to like export. There's dollars coming in, which will kind of balance out our trade balance. So that's another positive impact of currency depreciating. So I've spoken for a good 40 minutes now, or 37 minutes without stopping. So I'll stop here and then let's do it on a Q&A basis.
Tell me, I wanted to know, how is China doing as an economy? I'm not really interested just now in knowing versus India, but as an economy today, because you will probably be able to read from the Chinese yuan support that the government is giving, Chinese government. How is it doing overall? People say that it is in a recession and it is in a bad shape, but it's being supported from the government side, and people. It cannot go on for a long time. Especially there was this big time bubble burst in the real estate market there. Would you be able to say something on this, throw some light on this?
So the Chinese economy, term recession is used very. The recession means you have negative growth for two subsequent, by economic definition, you should have two simultaneous quarters, subsequent quarters of negative growth. That's not going to happen. So it's not that they will be ever having a negative growth, just like India will not have a negative growth for the next, many, hopefully not many decades, right? Because, we're all still emerging economies. Even China is still kind of to a large degree emerging economy. So technically they won't be in a recession, but they will be in a major slowdown. They've already slowed down, right? So they were at peak during Beijing Olympics time, that horizon, they were growing at anyway mid double digits, right? 14, 12, 15% growth was what's going on. Now they're targeting 5.3%. Okay, that's the government Communist Party target. They will come down. The expectation are if they do 3.5-ish, that's what they're expecting. They don't expect them to meet this 5.3 for next year. So that's their growth rate. Now, they've killed off one man, Zai, has killed the real estate industry single-handedly. He's killed the technology Alibabas of the world single-handedly. So he's kind of like making sure that there are no industry, private sector, which is run by some very rich person who can challenge him. So he's willing to kill the economy so that there is no challenge for him. So that's what he's done, right? He wants to grow semiconductors because he believes that rightly that semiconductors are cutting edge, and you need that for your war machine that he's planning and for future value-added growth and exports. So that's his mantra right now. He's like focused on a few sectors. Other sectors can go to hell. So therefore, all the engines of the economy are not growing, and there is rolling COVID issues that crop up. Any city with a few COVID people, he shuts it down. The entire city is shut down. So and that has psychological effects on people, and they don't know which city will be next shut down. So economic activity is kind of generally low in all of China. And then on top of it, lots of countries are like moving their supply chain away from China to other countries. And so generally there is that issue also, right? So while there is support for certain industries, it's not broad-based. It's definitely not right now, not to real estate. Maybe it'll come back because it's a very important sector. And so, yeah, their currency is also weakened, and they've pegged it against the dollar, but they've weakened it enough so that they are very, export-wise, they're quite competitive. They're not like us. They're not. It's not as strong. Rupees is a lot stronger than yuan at this point, but they're muddling around, but they're a large enough economy that they will survive without any difficulty, while they will not have any of the other emerging market problems. That's for sure.
Since we see that a lot of countries have started doing the trading in their own currencies, like euro, and even we are buying the oil in the local currency, even from the Russia and all. So will this in a long term affect the credibility of the dollar, what it is having right now?
That's what people want. Like the Russians and the Chinese don't want to have dollar as the reserve currency. Now, the question is, how many countries in the world believe in having yuan as their currency, right? As their reserve currency. That's not going to happen. So the dollar will stay as a dominant currency for quite some time. We can always get back into barter deals. These are barter deals, right? When you say I'll trade in rupee and ruble, it's effectively a barter deal. Yeah, I'm buying oil from you, and then in return I will give you something else. So we can always cut barter deals with various countries, but that's not the vast majority of the trade. Opportunistic, event that is happening. We will not want to do that with yuan. We will not support yuan as a reserve currency because it's against. They are an enemy of ours. There's no getting away from the fact that we are at war with China. They are a superpower at our border. They want to eat up all of Arunachal Pradesh, Ladakh, Jammu and Kashmir, God only knows what. So you can't be. You have to be like cognizant of the fact that you're dealing with a very virulent, hostile regime. And so whenever you're dealing with them, you can't support them by making yuan a reserve currency. Even though they're the second largest economy in the world, nobody would want to have yuan as their reserve currency. I don't think that be in their basket, maybe a few percentage. See, central banks have baskets of currencies that they maintain, right? I would say it'll be mostly dollars. So you'd own treasuries, you'd own some Japanese bonds, you'd own some euros, and after that everything falls off. You wouldn't own anything else, any other currencies, Swiss francs maybe, but that's about it. These are the currencies that central banks hold. They wouldn't hold rubles for sure, they wouldn't hold yuan for sure. So we will do some barter trades here and there, like when we're buying oil, maybe we give them rice in return. Yeah, but that's small. Yeah, but it's opportunistically beneficial to us because we are not using our dollars, and hopefully, that helps us, our currency.
So I think we have come to the end of this today's session. So thank you so much for giving in detailed explanation and information about this entire scenario on the global platform, because we always get a confusing messages, and whenever you try to talk to something in support of this situation, is always taken as a political inclination towards certain party. That is why we are supporting. But the people like you who are experts of the subject, you need to spread out these realities in whatever way, like this social media and all, so that people understand and have faith in our country's economy. That is what is the main idea of having this session today, sir. We thank you so much for accepting today's invitation and joining the session, sir.
You're welcome. Thank you for listening.
Thank you everyone for joining today's session. We'll see you all again on the next Saturday.